Hey everyone, it's Eyal Tropin, branch manager and designated broker at Model Mortgage Titan in Mill Creek, Washington. I'm here today to talk to you a little bit about some of the trends that we're seeing with the mortgage landscape, rate increases, and the real estate market, and how it's Eyal Tropin, and how these are going to affect us not just right now, but for the rest of 2022 and going into at least 2023. We are seeing a lot of things on the media talking about high risk of a housing bubble, high risk of decline in home prices, high risk of a crash, a lot of foreclosures. And I think that a lot of that is just alarmists, people who are have been making these predictions for at least 2-3 years now, some of them. And so far, it hasn't happened. I don't see a reason to think it's going to happen in the near future, but I don't want you to take my word for it. And that's what I'm here for. And I'm going to show you some collaborating data. And hopefully some of you will jump on the live stream and ask some questions. And maybe you'll walk away with a little more information on how you're going to work towards your goals of financial freedom, investing in real estate, getting your first home, whatever it is that you want to do in the real estate market. I'm here to help and support you. I'm licensed in Washington State, but can potentially help some real estate investors, most of the rest of the country. So come talk to me. I'm a real estate investor myself. I understand what you're going through. I love working with veterans. I love working with people who are self-employed. I know how to work with you and help you get to your goals. So let's dive right in and see what we're looking at. The first information that is affecting all of us and most important for what we're going to discuss here is inflation. Basically, when someone buys a mortgage-backed security, all your mortgages, you get a mortgage, they get packaged into mortgage-backed securities that are being sold on the secondary market in the stock market. Now, when someone buys a package of those mortgage-backed securities, every time the consumers make a payment on their loan, that portion of it goes to the investors as a return on their investment. Now, when we're talking about a 30-year fixed mortgage, those payments are fixed, they're not going to change. So if there is high inflation, that erodes the return to the investors, and it becomes less attractive. They don't want to buy it unless the return goes up. How does the return go up? Future mortgages that get sold have a higher interest rate, a higher return to the investors. So that's why right now, part of the reason why right now we're seeing the increase in mortgage interest rates. And that is how that affects. The other thing that happens is that with inflation, it reduces the buying power of a lot of consumers. Part of it is because home prices are a big part of the consumer pricing index. And as home prices go up, inflation goes up, people can buy less home with the same money. But also, again, because interest rates go up, you're not really buying a home price. You're not just buying based on the price of the home. You're buying a monthly payment that you can afford. And if that payment goes up, your buying power goes down. What do we do to battle that inflation? That's when the federal bank comes in. And they will hike interest rates. Those are short-term interest rates, not mortgage interest rates, mind you, and we'll talk a little bit about that. And they do what is known as a balance sheet runoff, where they're taking money away from the economy by selling some of the mortgage-backed securities that they've been purchasing for over 2 years now throughout the pandemic. They were buying tens of millions of mortgage-backed securities every month, or hundreds of millions of mortgage-backed securities every month. And that has gone onto the federal bank's balance sheet. Now they want to take money away from the economy. They do that by hiking rates and selling some of those mortgage-backed securities. Now, not only are they less attractive because of inflation, but now the Fed is selling them off, means that there is more supply compared to the demand. That means that interest rates again have to go up. But if they are successful in battling inflation, that means that those mortgage-backed securities become more attractive. So counterintuitively, it's not necessarily bad for mortgage rates. And again, remember, they are hiking the short-term interest rates, not the mortgage interest rates. However, all of that can also lead to a recession, meaning the economy starts to slow down. And historically speaking, that is a positive thing for mortgage-backed securities. Let's look at what happened over history. We had, the term when Burns, Volcker were chairs of the Fed. We had high inflation that was already at 7%, going up to 14%. Mortgage rates were going up from 12 to 18%. What does the federal bank do? They hike fund rates, the short-term interest rates, from 11 to 20%. Inflation responds going down first to 14%, then all the way down to 5%. And mortgage interest rates respond by going down from 18% to 12%, meaning this was good for mortgage interest rates. However, overall, it was bad for the economy because we had a recession with the S&P dropping 30%. Greenspan did the same thing. It wasn't as bad inflation. Maybe today's Fed would not have even responded to an increase from 1.75 to 3.5%. And mortgage interest rates went up just 1.5% from 7 to 8.5%. But he decided to hike interest rates, federal interest rates, from 4.75 to 6.5%. Inflation went all the way back down to 1%. Mortgage rates went back down to 5.5%, but we had a huge recession with a 50% reduction in the S&P 500. Already now the Fed is talking about several rate hikes. Last month they hiked the rate by a quarter. They're talking about up to 3% total in several hikes throughout 2022. We expect that will slow down or stop inflation. We are hoping to see another improvement to mortgage interest rates as a result. And again, this might cause a recession, and we already saw a significant decline in some of the leading indices of stock prices in the stock exchanges. So we'll see what happens with that. Now, if we focus for a second on mortgage-backed securities, those of you who are trading in the stock market might find this candlestick graph familiar. It's a little counterintuitive, but the higher the numbers on this graph of mortgage-backed securities are, the lower interest rates are. Now, this graph specifically represents the 4.5% coupon 30-year fixed mortgage. Just a few months ago in November, it was trading around 108. 108 means an 8-point credit compared to the 100 par pricing. We are now down to 101, 102. On a $1 million loan, that represents about $60,000 increase in the price of this same mortgage coupon. So you can look at it as a rate hike going from about 3.5% all the way up to around 6%, or you can look at it that the price of the 4.5% mortgage went up by 6% over this period of time. If we focus even closer on what happened since January, and we look we can draw a line from February 28th, we can draw a line through all the peaks of all those candlesticks, and we have a pattern of rates going up. We had last week a bit of an attempt to break out of this pattern, but it didn't hold, and right now we're trending again lower, or as it translates, higher mortgage rates. Inflation, we talked about it, erodes not just the returns for investors, it erodes your income as well. And we have seen over the past 12 months a 3.7% decline in your inflation adjusted paycheck. Now, depending on how the economy does, if the economy starts improving, you may get raises that will match inflation and keep your income as it was. But if that doesn't happen and we go into a recession, that is definitely going to affect you and your buying power. And when we're talking about the biggest purchase in your life, your home or your investment property, this is going to be very significant as we look at things like your debt to income ratio with the increase in actual interest rates and the reduction in your effective income. That is going to play a lot into your buying power. Now, you may have heard also on the news about a term called yield curve inversion. Basically, what it means is that if you're getting a 30-year fixed mortgage, you're putting all the risk on the lender. You get a fixed payment. It's not going to change no matter what inflation does, no matter what the stock market does. Your payment is fixed. Actually, if there is inflation, the real cost of your monthly payment is going to go down. If you are getting raises to keep up with inflation and your monthly mortgage payment does not change, effectively, it's going down. Now, if you're taking some of that risk upon yourself by taking, for example, an ARM, an adjustable rate mortgage, you're taking some of that risk upon yourself because you're risking, if you took a 5-1 or a 7-1 ARM, meaning that it's only fixed for 5 or 7 or 10 years, you're taking it upon yourself the risk that after that period, the rate might go up. For that, you should be rewarded with a better interest rate. And historically, that is true. But sometimes, and this just happened again, there is a yield curve inversion where those the consumer who's taking higher risk is not getting rewarded as much. And in some cases, in the yield curve inversion, actually the fixed 30-year mortgage long-term has better rates than the ARM products. And if we look at times in the history that this has happened, the gray bars are recessions. And so we can see that most of the times in history, when there was a yield curve inversion, it was followed shortly after by a recession. And this just happened again a couple of weeks ago. We saw the yield curve inversion. We're back up again, but we're hovering around that. So that is another leading indicator to a possible recession coming. What about employment? People tend to think that high unemployment is what causes and what leads to a recession. Actually, if you look at this historic graph, you'll see that it's when unemployment is at its lowest is when it gets followed by a recession that causes unemployment to go up. We had a huge spike in unemployment in 2020 because of the pandemic. As we opened up again, we saw unemployment rates very, very rapidly, like never before in history, decline. And if we, again, draw a line and, figure out what the lowest levels of unemployment were throughout history, we're pretty close to that. And again, that can be another leading indicator for a coming recession. Take that into account. What about the correlation between mortgage interest rates and recessions? I mentioned it earlier. When there is a recession, the economy slows down and mortgage interest rates tend to go down because of it. People are moving their money from the stock market into the bond market and into mortgage-backed securities, increasing demand for those securities, which results in better interest rates. And we can see that in most of the recessions throughout history, we've seen vast improvements in mortgage interest rates. So if we're right, and then we're looking at a recession coming, we might see an improvement on those higher interest rates that we're seeing right now. But again, there is no guarantee. I would not hold my breath. There are a lot of moving parts here. And if you're in the market to buy a home, the increase in home prices is going to be potentially a lot more significant. If rates go down, maybe you can refinance your loan later. But home prices, and you'll see in a moment, I predict that are going to continue to go up, and we're not going to see a collapse in the market. We'll see in a second why. So this, I think, is the most important graph in the entire presentation. Here we're looking at the blue graph is mortgage interest rates, the red graph is home prices, and gray bars are again recessions. You can see that there is no correlation between home prices or recessions and what home prices are doing. If we're talking about recessions, except in 2008, when the crisis, the recession was caused by the real estate and stock market and mortgage markets, that is the only exception. In all other times, home prices were either pretty flat or went up, and if they did not go up during the recession, they went up significantly right after the recession. But there is no place where this has caused a decline in home purchases. If we look at the 80s, when interest rates were over 17-18%, people were still buying houses and home prices were still going up. This is not 2008. First of all, look at the interest rates. They were in the sixes in 2008, but everyone who could declare that they had a pulse was able to get a loan with interest only, at 110% of the value of their home. They didn't have to show assets. They didn't have to show income. They had to declare everything. Right now, every new mortgage has to meet the ability to repay test. You have to show that you have the income to repay your loan, income or assets or a combination of both. If you're self-employed, maybe you don't have to show a tax return, but you still have to have been in business for at least 2 years and show bank statements that show that income. So there are alternative ways. They're usually at the higher interest rate, but there are ways in which you can have alternative ways to qualify for a mortgage, but you still have to be able to pay it back, or otherwise you won't get it. So we're not going to see what happened in 2008 repeat. What about the fact that home sales, pending home sales were down over 8% in March, okay? A lot of people say, it's the housing market is slowing down. We're going to see, houses stay on the market and prices going down, and we're going to see the bubble burst. Well, we have to put this again into context of history. 100% is on this graph the average of the number of pending home sales in the United States. And you can see that right now we're at right around 104.9 is where we are. Very close to the long-term average. And we're in a very solid place. We're seeing this huge reduction because we're starting from last year that broke all historic records. And remember, this is going back to around 2000. This is the highest rate of home sales in any time in the near history. So the fact that it went down, that's expected. It's a good thing. We can't keep up the same rate of house price increases and house price sales, and have mortgage interest rates go up. Interest rates go up, home sales go down. It makes sense, but we're very near the average. It's not a disaster. It's not a collapse of the market. Let's look at the total inventory. In December 2007, we had over 3.7 million homes for sale. Now we're at less than 900,000. That's almost a 3 million homes less in inventory right now. In most markets, we're around 2 to 6 months of inventory. This is nowhere near a balanced market. It is still a very strong seller's market. If we're talking about new construction, yes, there are over 400 new construction homes that are listed in one way or another, but only 35,000 of those are actually ready to be delivered. Most of them haven't, other than pulling permits, have not even started yet. Some of them just at the foundation level. And with the threat of inflation and a recession, home builders are not going to pour all their resources into fulfilling all those 400,000 home deliveries anytime in the near future. And even if they do, that is a far cry from how much we actually need. Why do we need so much? Because we have to look at the number of households. We have, millions of millennials turning 30 every year and building a family, leaving home, starting a job, and wanting to buy a home. Today, we have 14 million households more than we had in 2007. 14 million more demand with 3 million less supply. Even if the dynamics change a little bit, $400,000 homes for those 14 million households, that is a drop in the ocean. And that's why I think that the house market is going to remain solid. Can it continue to go up as fast as it did in the last 2 years? No, especially with inflation, especially with the increase in mortgage rates. But we're going to go down from going 120 to maybe going 150. They're talking in Greater Seattle about an expectation of around 15% increase in home prices. And remember, for every 100,000 in home price, an increase, even if it's just 12% annual appreciation, that means $1,000 a month for every 100,000 in home price. So $1 million home in 1 month might go up $10,000. And that's at just 12% appreciation, annual appreciation rate. If we look at all the price ranges from 0 to 500, which there are hardly any homes listed in that price range. They are in existence. They're just not on the market. Those people who live in those houses know that if they sell them, right now, 80% of the mortgages in the United States have rates below 3.5%. If they sell their home, they'll have to repay that mortgage and get a new mortgage for their new place at 6%. They're not going to sell so fast. So those houses are going to stay in very, very low supply. If we're talking about the $3 million plus home, less people can afford those. That's why we're seeing only 71% of those being sold in less than 30 days. It's still considered frenzy, even though it's 20% less that sell in just 30 days compared to the 0 to 500, where 95.5% of those sell in less than 30 days. We've been seeing, homes go on the market, sell in one weekend with 10, 20 offers, way over asking. Is that going to continue? No, it's going to slow down. But slowing down does not mean that house prices are going to come down. If you're greedy, if you put your house on the market at a price point that is too high, your house is going to sit. So talk to a real estate broker that you can trust, who really understands your market, who really understands what's going on in your neighborhood, and make sure that you're pricing it correctly, you're advertising it correctly, and you're getting the right traction for your home. It's a great time to sell right now. Demand is strong, very high, and inventory is low, but you have to price it correctly. Now, last thing is foreclosures. Again, I see all these things on the media. So many homeowners are upside down, and there's going to be a huge wave of foreclosures because we had the moratorium on foreclosures and people were in forbearance. Most of the people who were in forbearance kept making payments throughout forbearance. Those who were unemployed, most of them are back to work and have made at least 3 payments on their repayment plan and potentially even refinance to a lower rate mortgage. The national average of equity that was added in the last 12 months is over $55,000. In Washington State, it's over $95,000 in gained equity over just 12 months. If we're talking about Greater Seattle, for many homeowners, it's even higher, in the hundreds of thousands of dollars of equity that got added to their home in just the last 12 months. So if you lose your job and you absolutely have to sell, and inventory is low and demand is high, you just sell your house. If you look at the graph on the right, it's true, foreclosures are up 181% from a year ago. But what point was that? Look at how low that was. This data goes all the way back to 2005, and we're still well below that level. There's no huge wave of foreclosures in most areas that is coming. Most of the nation has seen huge increases in home values, so equity is there, and you can tap into that equity to get into a better situation financially overall. I am not a tax accountant. I'm not a tax consultant. I'm not an investment advisor. But talk to those experts, ask them if what I'm saying is true. You can consolidate higher interest rate debt into your mortgage for a much lower payment. Now, if you keep that debt or start racking up more credit card debt, you're going to be in trouble no matter what we do. But if you're doing this wisely and you're using the difference in the payment to pay off those debts faster, once you have consolidated them into your mortgage, you can pay them off a lot faster, and you can even pay off your mortgage a lot faster just by freeing up some of your cash flow by refinancing and using that equity for good. If the equity is just sitting in your home and you have other debt, that equity is doing nothing for you until you sell your house, until you move elsewhere. So take action, come talk to me. If you're looking to buy a home, need a solid, strong pre-approval in this market. So come talk to me and talk to your real estate agent. Let me know who your agent is, and let's get you to a better financial situation. Don't worry. I think that we're on solid grounds here on both the mortgage and the real estate markets. I know that I went into a lot of information in just 30 minutes. If you have any questions, anything not clear, come talk to me. My information is below. Have a great day.